So now I want you to think about taking profits and paying attention to percent gain rather than dollar gain. So a lot of people say, I'm gonna make $500 on this trade. I want to make $500 on each trade rather than maybe making 10 to 20%, which is a little bit more realistic. And we're gonna go into a scenario real quick. So let's talk about these two scenarios. One, we're gonna take a fixed dollar amount, and the other, we're just gonna take a fixed 20% gain on every trade. So in the first scenario, say you want to take profit on $500 on each trade. So you have $1,000 account. You make that first trade, you make $500. Now your account's at 1,500. So you nearly are up 50% from your original portfolio, which is really good. 50% is pretty high. So now your account starts growing. You keep taking 500 on each trade. Your account's slowly growing, but now your account grows to $10,000, and you now are still taking $500 on each trade. But now instead of that 50%, you're only making 5% profit. And now if that keeps going up, and now your account size is $100,000, that would only be a 0.5% profit, and then so on. So you can kind of see that. So now let's look at scenario two, when we're only strictly looking at percent gain. So again, we're going to focus on about 20% gain, and then you could do 10%, you could do 15%. I usually like to do about 15 to 20%. And so now let's take again that same $1,000 account. And so you take 20% of that account, which would be roughly $200. So that's already $300 from that first scenario. So that might not seem that great. And you slowly build it up, slowly build it up. So now your account's at $10,000, and you're still taking 20% on that 10,000. So now that 200 turns into $2,000 profit if you continue taking that 20% gain. And then again, if it's 100,000, it would become 20,000. So it's easier to scale a account when you're looking at percent gain rather than dollar amount. And it's hard, especially if you're new. You always want to say, oh, $100 or $200, $300 on this trade. But if instead you want to look at that percent gain, because that's slowly in the beginning, it's going to be very slow, but then it compounds, and that's the most important. And then it's going to really take off once you hit that 10,000, 20,000 mark. So as you can see, scenario two provides that there is a better way to focus on percent gains early on. So especially if you're new, it's good to kind of drill this in early on and to start focusing on percent gain, especially if you have shares as well. I know shares could be more long-term, but you could definitely, if you wanted to take some profit, because the stock will go up and down, that's just how it works. You could definitely take some percent out, and then when it goes back down, you could average down your cost again. So again, even though they may seem small at first, they can compound very quickly, and they grow your small account into a large account. And that's the most important, is being able to take a small account and turn it into a large account. Because it doesn't matter if you could take a large account and turn to a bigger, a larger account. It matters going small, because a lot of people starting out might only have $500, $100 to invest. So if you're risk managed, you could definitely slowly take your account up. And so the last thing is just to remember to cover and cut your losses quick. So there's this quote right here that I really like. So selling your winners and holding your losers is like cutting the flowers and watering the weeds. So there's no point of doing that. And so this chart I have kind of gives you an idea of, if you lose 1%, you only need 1% to gain it back. If you lose 5%, you only need 5%. 10%, you only need 11% to gain it back. But you see, as the losses get bigger, if you take a 50% loss, you need 100% gainer to just make up to be even. 80% is over 400% gain. So it's better to just cut it quickly, 10%, 20%, again, whatever is comfortable for you. Then you really only need that 11% or 25%. And it's easier to recover from your losses than to hold it and hope, if it goes all the way down to 100%, hoping that it's going to turn around and you might turn a profit. In some cases, you might get lucky and that might happen, but it's better just to cut it. And again, if you're charting and everything, and you realize that prediction was actually right, you cut your loss at 10%, you get in a little bit when the stock's a little bit lower, and then you write it up, and then you're going to cover your losses plus a little bit more of a gain. So hopefully this makes a little bit more sense. And then in the upcoming videos, we're going to be doing charting. So you have a better understanding of what to actually look for instead of just hoping to buy and sell at highs and lows. So again, you could always leave any comments. If you have any questions, you could always reach out. And so we'll see you next time. Thank you.